Rejection wick shows that the market wants to go in the opposite direction. And this is something what I will show to you on the chart on different time frames. Me personally, I love to trade the 1 minute chart, but we're going through also a 30-minute and then also a 1-day chart. So first of all, before we go through candles, it's important to understand market structure. That means very important to understand is that when you have a market that is trending for hours, it's just going down. It's going to consolidate, as you can see here. So there's always a push, consolidate, push. So that's how the market likes to run. And there's sometimes days where the market is less consolidating and sometimes more consolidating. We're talking about like from bigger structure that the market likes to stay in one price. And what we have literally is that when we see that the market is going down, consolidate, very often you will see in this consolidation phase a wick upwards. And when that's the case, it means it's finished here. Nobody likes to continue trading here. And then very often you see then that the market likes continue going in that direction until you see on the bottom side that there's a very big wick. And then the market just likes to consolidate or even reverse. A very big problem with wicks, and this is something what is very important, do not just trade in that direction. You want to see that the market is confirming you that push. And for this, I have a rule. For example, if you are in a smaller chart, like a 1 minute chart, what is very awesome, that you want to see when a lot of red candles, not more than 3 green candles, for example. And when the market is going up, you just don't want to have more than 3 red candles, for example. So you want to see a strong enough push here. Okay, let's just go into the 1 minute chart. Important here is that you set up your time zone here. In this case, we are here in Chicago time. And then we go here between like, let's just say you would trade like for 2 or 3 hours between like 9 a.m. I think is really, really good. Between like to like 11 or like 12. We go here to this time area. And then you want to see wicks here, right? So as you see here, for example, the first long wick that we see here a bit is up here. So you see the market is pushing up, does a wick, and then starts to go in a consolidation phase and then goes down. And then you see here, there's a consolidation phase. Here's a wick again. And then you see the market comes back up to the consolidation phase. And then it just continues going in the direction where it's supposed to go. So you can see here that the market was going here in a small downtrend, right? So let's just look at a couple of times between like different kind of time areas. And also, of course, explaining to you that sometimes you'll see here, as you can see here, that the market doesn't move. You'll see that the market starts to wick here. And then very often the market starts going in a consolidation phase and it's not that much worth trading there. Because very awesome is when we can get into a trade while the market is trending, as you can see here, until you will see that the market is doing here, down here, a very long wick. Or also what is really good is if you see a red and a green candle and they are long, this comes with experience like this one, can be seen also as a wick because you can just see like it was going down very fast, it was going up very fast, and you just see it's like a wick here, down here, and then the move is just finished. So that means for your trade management, that means without any target, if you don't have any bigger structure low, in this case we have here a bigger structure low here or a smaller structure low like from here as a target, and we could combine it with the wick or this long color switch, for example. Like as you see here, the first wick is happening here a bit, it's here a bit wicky with our target, but then touching it, and then here you see a wick down here or this color switch here can result already as information for us that it's already finished and that the market wants to go in a consolidation phase for multiple hours, as you see here. It is not that much worth it to trade. So let's just look at specific times between 9 a.m. and 11 a.m. And then from there on, we will look here at wicks, because if we just look in the chart, it's not that efficient. It's just important that it's to a time where you're also available to trade. So here, for example, if you start your trading and you see that the market is already going up for several hours, as you can see here in an uptrend, it's just important to try to ride the trend. What I really love is to measure what length the market did, as you see here, also for the future here, and then here. So you see here, there are similarities in retracements. And then when you see the similarity in retracement, you can literally also use there the wicks. You see here, here's also a wick here against us before we start our trading. So we need to be very careful here. And what we want to see is something like that we see here, like long or like lots of green candles, what just happened here. So it's neutralizing this wick here. So not just buying here is very important against this wick. And then once you see the market is doing a retracement, it's called, of same length, what the market did here for 2 or 3 times also in the past, as you see here, what I'm drawing here in, then it's just very interesting. Once the market does this one, and now you see here wicks down here, that this is for us a signal that it makes sense that the market continues going in that direction. So again, you see here the market does again a length from here to here, does here a wick around in this area, and then you see in this area here around, when we see here the first time powerful candles like here and there in comparison to the other ones, you will see that the market shoots up now. So important is not just to enter a trade, by the way. What I see a lot with beginners that they don't make money yet is because of the money management. If you would trade one of these big green candles with the stop placement down here, your risk reward ratio often is just 1 or 2. And this is just not enough. What is important is that you understand how to have a risk reward ratio of 1 to 5 or even greater in average. And the answer to this is that to read that the market is doing that push out as explained. And then afterwards, we want to have a signal like a small color switch, as you can see here, that when adjusting $100, we get here a risk reward ratio of 5 in combination with the wicks. This is something which is very important. We're going to look at one more day. If we go here to the back, that you can also do this on your own trading chart, and then we just go time frame up higher. That means we have here 9 a.m. for example to like 12. Here you see, if you look at the past, you see that the market is here just consolidating. We have here a bigger structure high that is up here. You see how the market is pushing up here on the progress, and then now the market does a retracement. Now check this out. We have a retracement length from here to here around in this consolidation phase that is shifting up higher. We have around the same length here, and down here is our wick. In combination now, this time we have a color switch that is small enough that when adjusting here $100, it's around almost $500 would have been reached here sadly. But to this high here, what is very close is a risk reward ratio of 4. That means when adjusting now with enough leverage, a position size of $100, it's a $400 trade out until here. And then on the way also, this is what I mean that by we don't have to trade where the tip is. We can wait for this information and then just ride on the trend. You can see here there are also risk reward ratio trades of 3.8 or like around 4. What is just very important is every time you see like more than 3 red candles or like that there are a lot of red candles, it's sort of a consolidation phase, what is just not that nice. And it's just important to understand the days. So what I really love is to measure, as you see here already, their retracements. They have almost here the same length. They go a bit by smaller. Check this out. From here to here, from here to there, the first green candle. And then when you see that the market does around the same length in retracement here as you see here, this is just something what's very interesting. And then you want to see here long wicks. So here, for example, is a long wick down here. What confirms us then starting here, the market wants to push up. And then with experience, you will see that there will be days, as you see here, that there are too much wiggling around. And then like the day before that the market is not wiggling around. So when you use a 1 minute chart, the cool thing is, as you just saw in the beginning now until here, is that we have a lot of information about wicks. But when you trade, for example, in, let's just say here, a 30-minute chart, the problem here is that you would maybe need to trade for, instead of 1 or 2 hours, you need to trade maybe within like 4 hours, 5 hours, 6 hours, 7 hours, because you need to consistently understand what the market is doing. So that means, for example, like seeing here that the market here a wick, does here more than 3 red candles going down here in the 30-minute chart. And then what doesn't want to go above here out, wants to go first down here to the first low. A low is always a red and a green candle. So aiming then for this target, and then when the market is doing good here, check this out. You can see after the market reached this low that the wick is on the top side longer. That means first there was no interest down there, then there was no interest up there, and then now the market wants to go here to the next low, and then even to the biggest structure low here, as you can see here, to target. So it works also very good. Or as you can see here, what I just explained in the beginning, you see that the market is going in a downtrend, is wiggling around, and then starting when you see here a lot of wicks and the market is going down here. Very important, not just when the market is here doing wicks. You need always to let the market push out. Then starting here, we can assume that the market continues going lower and then just literally ride the trend. That means we don't want to read here the wicks. We want to see the wicks and the push in combination. This is called price action, and this can help us a lot. And the same thing is also then when we go here into a 1-day chart, is that when we just look at the current market situation, that means as we are here right now, we look at the bigger structure high. You see that there's this color switch, and this is like a wick in combination with green red. And then you see a wick up there. There was no interest. Then you see a wick is down there. So right now it makes then more sense because there's a wick down there and you see it going for multiple days up, that the market at least wants to go here to this smaller structure high of yesterday's high, this area here. And this is how wicks can literally help you. Or as you can see here, market was going lower. That's here the wick. And then you have from this 1-day chart, this high here. And then until you can see then here that the market was reaching this one until the tier wick. Then it's important not to trade here until you see down here's a wick, a green candle. There's down here longer wicks, as you can see here on the upper side, and then trading again up here to this high here, as you can see here. Try this out for your trading. Is something what is very, very powerful and efficient. Very highly to recommend to stay always just on one chart. I highly recommend actually just using the 1-minute chart, but it depends, of course, what trading strategy you have. And one of the biggest refinement what I see is always literally first seeing in what direction market is going at, and then the trading strategy should help us to increase signals that we have available and also the risk reward ratio for each signal on average.